Right now, gold is trading at record highs, and people are lining up to buy it for the exact same reason their grandparents bought it during every panic in history. Because you can hold it in your hand. And that single fact, the ability to physically touch an asset, is quietly costing an entire generation hundreds of thousands of dollars without a single one of them realizing why. Here's the part nobody's saying out loud right now. Gold doesn't pay you anything. It doesn't generate income. It doesn't compound. It doesn't put a single dollar in your pocket while you own it. Real estate has the opposite problem. Everyone's frozen, waiting for rates to drop, convinced that timing the market perfectly is the only smart move. Both groups think they're being careful. Both groups are about to find out what careful actually costs. Meet Priya and Daniel, both 34, both living in Denver, Colorado. Both just received a $60,000 bonus the same month. Same amount, same city, same age, same financial starting point. Both have spent the last year watching the news, watching prices climb, feeling that low hum of anxiety that says do something with this money before it's worth less tomorrow than it is today. Priya takes her $60,000 and buys gold. Physical bars stored in a safety deposit box at her bank. At current prices, that's roughly 23 ounces. She feels something settle in her chest the moment she locks that box. Whatever happens to the dollar, whatever happens to the markets, she has something real. Something nobody can print more of. Something nobody can take from her with a keystroke. Daniel takes his $60,000 and puts it as a down payment on a $300,000 rental property, a small, single-family home in a stable neighborhood. He takes out a mortgage for the remaining $240,000 at 7% interest. Monthly payment comes to $1,497. He finds a tenant willing to pay $2,100 a month. On paper, that's $503 a month before anything else enters the picture. On day one, here's what's strange about this story. Almost nobody would call either of these choices reckless. Gold feels safe. Real estate feels smart. Both of them walk away from that decision, feeling like they did the responsible thing. And in 20 years, only one of them is going to be right. And it's not for the reason you'd expect. Priya's gold sits in that box and does exactly what gold has always done. Nothing and everything simultaneously. In year one, gold prices climb roughly 12%. Which sounds incredible until you realize what that actually means in dollars. Her $60,000 in gold is now worth approximately 67 of his $200. She didn't do anything to earn that. She also didn't do anything to lose it if prices had gone the other way, which they easily could have. Here's the psychology hiding inside that 12% gain. Researchers call this outcome bias. When a decision produces a good result, your brain retroactively decides the decision itself was smart, even when the outcome had almost nothing to do with the reasoning behind it. Priya bought gold because it felt safe. The fact that it went up 12% has nothing to do with safety, and everything to do with timing she couldn't have predicted. Her brain doesn't know the difference. It just files this away as proof she made the right call. Daniel's first year looks messier from the outside. His tenant is reliable, but his water heater fails in month 8, $1,400 to replace. His property taxes come in higher than he estimated, at $3,600 for the year instead of the $2,800 he'd budgeted. After his mortgage, taxes, insurance, and that one repair, his actual net cash flow for the entire first year is approximately $1,200. Not the $6,000 the math on paper suggested. $1,200 for taking on $240,000 in debt and the responsibility of being a landlord. If you stopped the story right here, Priya looks like the genius, and Daniel looks like he made an expensive mistake for barely any return. But neither of them has any idea what the next 19 years are actually going to reveal about the asset they were both so sure they understood. By year 3, gold has had a wild ride that nobody talks about when they're only looking at today's record highs. Prices climbed through year 1, dipped nearly 8% in year 2 as the panic that drove the rally faded, then climbed again in year 3. Priya's $67,200 is now worth approximately $71,500. Over 3 full years, her gold has grown a total of roughly 19%. Not nothing, but nowhere near what the year 1 excitement promised. And she's paid for a safety deposit box every single year to store it. Roughly $150 annually, just to keep her own money safe from theft. Daniel's property, meanwhile, has been doing something gold structurally cannot do. Denver real estate appreciated a modest 4% annually over this period. His $300,000 property is now worth approximately $337,000. His mortgage balance has dropped to roughly $232,000 through regular payments. His equity sits at approximately $105,000. He started with $60,000 in cash. He now controls $105,000 in equity, and his tenant has covered nearly his entire mortgage payment for 3 straight years. Here's the pattern interrupt that should genuinely surprise you. Daniel's property only appreciated at less than a third the rate of gold's best year, and he's still pulling ahead. The reason has nothing to do with which asset is better, and everything to do with a mechanism gold can never offer you: leverage. Daniel only put in 20% of his property's value. He's capturing 100% of the appreciation on the full $300,000, not just his $60,000 slice of it. Priya put in 100% of her gold's value. She only ever gets 100% of whatever gold itself does. No multiplication, no leverage. Just a direct, one-to-one relationship between her cash and her outcome. By year 5, the gap becomes impossible to explain away. Gold has had another rough stretch. Global panic that drove the original rally has cooled significantly, and prices have essentially flatlined for 18 months. Priya's holdings sit at approximately $74,000. A 23% total gain over 5 years on an asset she was told was the smart, safe move. Daniel's property is now worth approximately $365,000. His equity, after 5 years of mortgage paydown and appreciation, sits at approximately $138,000. His tenant has covered essentially his entire housing cost for half a decade, while that equity quietly built underneath him. Side by side, Priya has $74,000. Daniel has $138,000 in equity, plus 5 years where someone else paid for his property. Same starting amount. Same 5 years. The gap is $64,000, and gold isn't even doing anything wrong here. It's doing exactly what gold has always done throughout history. The problem isn't gold's performance. The problem is what people expect from an asset that was never designed to generate income in the first place. Your brain has a specific blind spot here, and it's called the dormant asset illusion. When you hold something tangible, gold, cash, a physical object, your brain registers it as safe, specifically because nothing about it changes day to day. But that same stillness that feels like safety is actually opportunity cost, silently compounding against you every single year. That asset sits there generating exactly zero income while inflation and other assets move without you. Here's the hidden truth that explains why gold buying surges happen in waves all at once across an entire population. And it has almost nothing to do with gold itself. Gold doesn't sell itself on returns. It sells itself on fear. Every major gold rally in history has been preceded by the same emotional trigger: currency instability, geopolitical panic, inflation headlines, a sense that the systems people normally trust are becoming unreliable. Gold isn't purchased primarily as an investment decision. It's purchased as an anxiety management tool, and the price reflects collective anxiety far more than it reflects any underlying productive value, because gold produces nothing. It just sits there, waiting for someone else to be anxious enough to pay more for it than you did. This is called herd-validated risk perception. When enough people around you make the same financial decision simultaneously, your brain interprets the size of the crowd as evidence of the decision's safety, even though a crowd's size has zero correlation with whether a decision is mathematically sound. Priya didn't just buy gold because she researched it. She bought it because everyone around her was buying it too, and that shared behavior felt like proof. What happens next, when you watch 15 more years unfold for both of them, is going to make you question every safe financial decision you've ever made, and possibly every one you're about to make. By year 20, the full picture has stopped being subtle. Gold has gone through 2 more cycles in that time. A sharp spike during a currency crisis around year 12. Then another long flat stretch that lasted nearly 4 years. Averaged across 2 full decades, gold has returned approximately 4.5% annually, which is actually close to its long-term historical average once you strip away the emotion of any single rally. Priya's $60,000 is now worth approximately $146,000. She's paid roughly $3,000 in storage fees over 20 years just to keep it secure. Plus the quiet cost of checking gold prices every time the news mentions inflation. Recalibrating her sense of safety against a number that moves independently of anything she does. Her real total gain, after storage costs, sits at approximately $143,000. Daniel's property, after 20 years of modest 4% annual appreciation and steady mortgage paydown, is now worth approximately $657,000. His mortgage is paid off entirely. His equity is the full $657,000. Across 2 decades, his tenants have covered the vast majority of his housing costs, and he's collected rental income the entire time on top of that growing equity. His total wealth from that single $60,000 down payment, $657,000. The gap between them is $514,000. Same starting amount. Same 20 years. One of them held something they could physically touch. The other held something that worked for him while he slept, paid down its own debt, and generated income the entire time he wasn't thinking about it. Now here's the reframe that should change how you think about every safe decision you make from this point forward. Priya didn't make a foolish choice. She made the choice that felt safest to a brain, built to trust what it can hold over what it can only calculate. For most of human history, physical possession was the only form of wealth that mattered. You could see it, defend it, pass it directly to your children without a lawyer or a bank involved. Paper promises, mortgages, equity positions. These are recent inventions in the timeline of human psychology, and your brain genuinely hasn't caught up to them yet. It still runs ancient software that says, if you can hold it, it's real, and if you can't, it isn't. Daniel's mortgage never felt as safe as Priya's gold bars sitting in that box. Of course it didn't. He spent 20 years owing money to a bank for an asset he couldn't move, couldn't liquidate quickly, couldn't physically defend if everything fell apart. But that discomfort was never a signal that he'd made the wrong choice. It was simply the price of accessing a kind of growth that tangible assets structurally cannot provide. Leverage, income, and compounding, working together, simultaneously, for 2 decades, without requiring his attention or his anxiety to function correctly. This is why gold rallies and real estate freezes happen in waves, generation after generation. Regardless of how much information is available to anyone making the decision, it was never a knowledge problem. It's an inherited instinct that mistakes stillness for safety and mistakes growth for risk. And almost nobody ever stops to ask whether that instinct is still giving them accurate information in a financial system built entirely differently than the one it evolved for thousands of years. Ego, and here's the part that should sit with you a little longer than the rest. Priya's $143,000 gain feels enormous in isolation. It's more money than she started with, more than doubled, a genuinely good outcome by almost any normal standard. The trap isn't that gold failed her. The trap is that she'll never know what she actually gave up because opportunity cost doesn't send you a bill. It doesn't show up as a number anywhere. It just quietly exists as the gap between what happened and what could have happened, invisible unless someone runs the comparison for you. So what should you actually do with this? Gold isn't worthless, and this isn't an argument to abandon it entirely. As a small percentage of a portfolio, most financial professionals suggest somewhere around 5 to 10%. When, dependiendo na gold can genuinely buffer against currency instability and serve as real insurance during periods of crisis. That's a legitimate use case, and it's worth respecting. The mistake isn't owning gold. The mistake is owning gold as your primary wealth-building strategy because it feels safer than assets that actually generate income and growth over time. Real estate isn't automatically the better choice for everyone either. It requires capital, credit, tolerance for debt, and a willingness to manage a property or pay someone who will. Not everyone has that capacity, and pretending otherwise would be its own kind of dishonesty. But the math is clear about one specific thing. Assets that generate income and benefit from leverage compound in ways that dormant, tangible assets simply cannot replicate, no matter how reassuring they feel to hold in your hand. If nobody ever explained to you that the comfort of touching your money and the growth of your money are 2 completely different things, often working directly against each other, that's exactly the conversation this channel exists to have every single week. With a different financial decision, most people never stop to question. Drop in the comments, are you a Priya or a Daniel right now? And be honest about why you choose what you choose. Because the reason behind the choice usually matters more than the choice itself. And most people have never actually examined their own reason. The assets that feel the safest to hold are often the ones quietly costing you the most to keep holding.